Investing sounds exciting. Put in some money and watch it grow. But for beginners, the truth is most people lose money, not because investing is bad, but because of simple mistakes. Let's go through the top 10 investing mistakes beginners make, explained in the clearest way possible. Chasing quick riches. One of the first traps new investors fall into is the idea that investing will make them rich in a week. They hear about someone who bought a stock and doubled their money in a month, or a friend who made thousands from a trendy cryptocurrency. The excitement takes over, and they start throwing money at whatever is hot right now. The problem is, by the time most people hear about an opportunity, the big gains are already gone. The price is at its peak, and that's when beginners jump in, only to watch it crash days later. Real investing is not gambling. It's not spinning a slot machine. It's about steady, disciplined growth over time. Quick riches are rare, and chasing them usually ends in regret. Trying to time the market. Another huge mistake is believing you can predict the perfect moment to buy or sell. Beginners think, I'll wait until the market crashes, then buy low. Then I'll sell right before it drops again. But here's the truth. Even the world's most experienced investors, with billions of dollars and teams of analysts, can't time the market consistently. Prices go up, prices go down, and no one can always predict when. Beginners who try usually end up waiting too long, missing opportunities, or selling too early out of fear. Instead of trying to play fortune teller, the smarter approach is to invest steadily and let time do the heavy lifting. Putting all eggs in one basket. It's tempting to believe in one company so strongly that you invest everything you have into it. Beginners often say, this stock is guaranteed to explode. I'll put it all in here. But if that company has one bad year or one bad headline, your entire investment could collapse overnight. That's why diversification, spreading your money across different industries, companies, and even asset types, is key. Think of it like building a table. With one leg, it wobbles and falls. With 4 or 5 legs, it's stable. The more you spread your investments, the more protected you are from unexpected crashes. Ignoring fees and costs. A lot of beginners don't even notice fees. They sign up with a broker, buy a mutual fund, or invest in a retirement account without realizing they're being charged every year. 1% might not sound like much, but over 20 or 30 years, that tiny slice compounds into thousands of dollars lost. It's like slowly leaking air from a balloon. You don't notice at first, but eventually it deflates. Beginners need to understand that fees eat directly into their returns, and the less you pay, the more your money can grow for you instead of your broker. Investing without a goal. Jumping into investing without a clear reason is another beginner mistake. Some people invest because it's good to invest, but they don't stop to ask, what am I actually trying to achieve? Are you saving for retirement, a house, or just trying to grow wealth over decades? Without a goal, your strategy is random. You might invest too aggressively when you need safety, or too conservatively when you actually need growth. Having a clear destination makes it easier to choose the right path. Otherwise, you're driving blindfolded with no map. Following the crowd. It's human nature to copy what others are doing, especially when money is involved. When you see everyone on social media hyping up a stock, it feels like you're missing out if you don't join. Beginners often rush in because they fear being left behind. But the truth is, if everyone is already talking about it, you're probably late. By the time regular people pile into an investment, the price is inflated and it often drops shortly after. Following the crowd doesn't mean following success. It usually means buying high and selling low. Independent research and patience are far more reliable than hype. Panic selling during dips. Markets never move in a straight line. They rise, they fall, sometimes sharply. Beginners often panic the first time they see their investment drop 10, 20, or even 30%. Fear takes over, and they sell everything at a loss just to protect themselves. The problem is, markets have always recovered over time. History shows decades of upward growth despite countless dips and crashes. Those who panic sell miss the rebound and lock in their losses forever. The real skill in investing isn't picking the best stock. It's having the patience to ride through storms without jumping ship. Forgetting emergency savings. A beginner mistake that doesn't seem obvious at first is investing all your spare cash. It feels smart. Why let money sit in a bank when I can make it grow? But life is unpredictable. Cars break down, jobs get lost, medical bills appear out of nowhere. Without an emergency fund in cash, beginners are forced to sell their investments at the worst times, during a dip, or before they've had time to grow. An emergency fund is like your financial safety net. It keeps you from touching your investments before they're ready. Not doing any research. Some beginners invest just because someone told them to. Maybe a family member said, "Buy this stock," or a friend bragged about a hot tip. They never bother to look into what the company does, how it makes money, or whether it even fits their goals. That's like buying a car without checking if it has an engine. Blind investing almost always ends badly. Even a few minutes of research, understanding the basics of what you're buying, can save you from disaster. Knowledge is your strongest protection. Expecting guaranteed returns. The final mistake is believing investing is a sure thing. Some beginners think, if I just put my money in, it will double in 5 years. But no investment can guarantee results. Not stocks, not real estate, not crypto. Risk is always part of the game. The key is not to avoid risk entirely, but to understand it and manage it wisely. Thinking you can win without risk is like believing you can swim without getting wet. Successful investors know there will be ups and downs, and they plan for them instead of pretending they don't exist. Investing isn't about being perfect. It's about avoiding simple mistakes. Don't chase quick money, don't panic at losses, and don't ignore the basics. If you invest with patience, discipline, and a clear plan, you'll already be ahead of most beginners. If you like the video, give it a thumbs up, it really helps. And if you want more content like this, consider subscribing. Got an idea for what I should cover next? Drop it in the comments.